Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's supply and demand Forex, gold, and S&P fundamental and technical analysis for the week ahead, starting the 9th of February. Hope you all had a great trading week. And so let's get into the week ahead fundamentals. And next week in the US, investors will focus on the CPI report and Fed Chair Powell's testimony before Congress. Key economic releases include producer prices, retail sales, and industrial production. Beyond the US, markets will closely watch China's CPI, PPI, and monetary aggregates, and GDP growth figures for the UK and Euro area. So, a few things going on for the major currencies. So, getting into some of the technicals and this week's fundamentals. So, starting off on the equally weighted dollar index, and the dollar index, um, dollar overall, has pulled back a bit, right? So, really, the narrative at the moment is being driven by Donald Trump and trade tariffs. And Trump says he plans reciprocal tariffs will affect everyone. The US president also indicates he could tax foreign automobiles. Threat is latest in series of trade warnings from White House. So, as long as Donald Trump continues to be quite hawkish and quite aggressive with trade tariffs and making certain threats, then that should support the dollar from a risk sentiment perspective. The dollar typically does appreciate in a risk off environment. We did see a pullback this week, quite a drastic one, based on Donald Trump being quite dovish when it came to tariffs on Canada and Mexico, where he kind of gave them an extension, a 30-day extension, and said that he will start to renegotiate in March. And so, in the short term, I do believe that the price of the dollar is going to be quite volatile and will be driven by not only the fundamental side, but of course trade tariffs, the dominant narrative for the market. But also as well, we do have, and let's go to United States channel. We did have slowing but healthy US jobs growth combined with rising inflation expectations supports the Federal Reserve's inclination to keep interest rates on hold for the foreseeable future. So, non-farm payrolls came out on Friday, and the data wasn't necessarily, if you looked at the numbers, it wasn't necessarily fantastic. It came in lower, but the unemployment numbers also came in lower, which is the sign of a decent economy. And also, as well, average hourly earnings, which is an inflation measure, came in higher. So the central bank, the Federal Reserve, they kind of took away from that the economy is still doing okay. Employment is still okay. Unemployment is still low, which is a positive. But also, when it comes to cutting rates, central banks typically don't cut rates when there's rising inflation, because if you understand what inflation is and what cuts will do and the effect that cuts are supposed to have on inflation, which is contributing to rising inflation, then actually when inflation is rising, what you need to do is either hold interest rates or hike interest rates, not cut interest rates. So, it says here the report illustrates a moderating yet still strong labor market that continues to fuel the economy, while proposed policies from the Trump administration risks reigniting inflationary pressures. That helps explain why Fed officials have signaled they aren't in a hurry to lower borrowing costs further after a full percentage point of interest rate cuts last year. So the Fed are now, for now, still holding rates, which should support the dollar, as well as the uncertainty around Trump's tariffs. So ultimately, we should see the dollar move to the upside, of course, if the data does support that. But even if there is another pullback on the dollar, I do believe that the dollar should still be a buy, whether it's a buy now. or it's a buy as it pulls back. As long as the data does continue to support the Federal Reserve holding rates, then the dollar is a buy on pullbacks, in my opinion. Looking at the dollar yen, and the yen has really increased in strength and appreciation over the past week or two, and it's really based on a hawkish Bank of Japan. So it says here, as well as the data, so it says the yen is on track for its fourth straight weekly gain against the dollar, as spending data on Friday added to signs that the Bank of Japan will raise rates again. Gains gathered momentum Wednesday when Japan's wage growth, and again, wage growth like average hourly earnings in America, the wage growth jumped by the most in nearly 3 decades and accelerated further Thursday as a Bank of Japan hawk said that borrowing costs should be doubled to at least 1% by the end of March 2026. So again, with wage growth being a nearly 3 decade high, inflation is an issue and becoming an issue, which then means that central bank, or the central bank of Japan, should look to hike rates, right? So it says here as well, just quickly, it says the more hawkish headlines from the Japanese official on domestic policy have created some enthusiasm for the long trade, says Jerry Minia, co-head of G10FX trading at Barclays PLC in London. We think this is driven more by the yen than dollar, as there has been considerable pickup in the interest from clients from buying the yen against other currencies, he said. So the yen, although I don't see it as a buy against the dollar, because ultimately what you do want to do is look for strength versus weakness. If I'm a buyer of the dollar, and I think the dollar is going to strengthen overall against most currencies. If I'm looking to buy the yen, then there are other currencies I really should be pairing that against, weaker currencies than the dollar. So I'm not really interested in this pair, in trading it, but if you are, then your options really are, if you're looking to buy dollars against the yen, then you're looking at a buy down in that demand zone. If you're looking for a sell trade, you're looking for a pullback of some sort into a level of supply before looking at going short. But fundamentally, this is more of a difficult trade to gauge. So ultimately, I'm not really interested in this. I am interested in the dollar Swiss. Didn't necessarily manage to get into this trade. I've got into the pound, dollar, and the New Zealand dollar, so I didn't want to take on too many dollar trades. But also, there wasn't an entry for me. An entry didn't appear down here for me. So if there wasn't an entry and prices move higher, then oh well, so be it. What can I do? But no, there were some traders in the group that managed to get involved in this trade. Their entries are a bit different from mine, of course. Not everyone has the same entries, but as long as we're all making money, that's the main thing. And entries really aren't the be all and end all. In fact, they're just the icing on the cake when it comes to a technical strategy, just a trigger, really. But yeah. Swiss franc should be really the weaker out of the two, and so really the buy on this pullback was to be expected, and this is what's happening now. If prices do pull back, for any reason, because they can always pull back, I do think any buys around this area, around the 0.902 to maybe the round number, or even just below that, the 0.897s, should be decent for a buy trade. I can't see the Swiss franc strengthening against the dollar anytime soon, significantly, right? And when I say strengthening, I'm not talking about like just one day going down or 2 days. A significant strength, meaning like a proper reversal where you've got a few hundred pips, 3, 4, 500 pips, to the downside. I can't see that happening for now. Of course, it depends on the data, but for now, the dollar is king. Looking at the dollar CAD, and the Canadian dollar has again strengthened mainly on Again, Donald Trump's tariffs extending, or the extension of Donald Trump's tariffs, and so that's the reason for this pullback. But ultimately, out of the two, I would expect the dollar to continue to strengthen. So, if you are looking for a buy trade at the moment, then this should be really a nice buy. There is the possibility of a stop hunt below that level, and even if it drops a bit more down to this demand zone, I would expect the dollar to strengthen around the 1.42s, 1.4150 area. There is actually a nice some nice confluence with some support and resistance there. So that is quite nice. But overall, I think the path of least resistance is still to the upside. So that is what I would be looking for. But the Canadian dollar did have some good economic news. I think unemployment came down a bit. Employment went up, unemployment went down. But again, the narrative is really more about uh, the uh, the effect of tariffs, and because of the close geographic proximity of Canada to the US in terms of they're pretty much neighbors, right? Um, and they do a lot of trade. Donald Trump is kind of focused on getting them to kind of play ball, and Canada isn't in necessarily the best negotiating position when it comes to their economy. So the dollar really should have the edge. Pound dollar. So pound dollar, I did get into this trade. So I was stopped out of a remaining position, and that trade ended up being a small win. And then I ended up getting involved in another trade this week, which was on the Wednesday, and so that now is a profitable trade. And so I'll speak about that in the trade updates and the new trades. So, but if you're looking at going, I guess, a trade direction, I think the path of these resistance should continue to be to the downside. The pound at the moment, they did cut rates. There was a bit of confusion on the day, and maybe a day after as well, where the market kind of perceived it as a bit of a dovish cut, but then there was some kind of hawkish news that kind of came out. But then overall, as the dust has settled, there was an article, a really good article, matter of fact, which kind of points to uh, the pound being more of a sell than a buy. And so understanding really stagflation, and many of you may not understand what stagflation is. And stagflation is where you have inflation, right? So you have inflation and you have GDP. Now, normally inflation and GDP move in the same direction. So if you have inflation rises, what should happen, or what typically happens in the cycle, is that you have GDP normally is in the expansion or the boom phase, or at least the recovery phase. And when you have inflation that's coming down in their cycle, and in the contracting in their cycle, you normally have GDP contracting as well, going into the contraction, maybe recession phase, right, of their economic cycle. Now, with inflation going higher, you normally have, and GDP going higher, you normally have interest rates that also will go higher. And when inflation and GDP is on its way down, interest rates are normally held or cut, right? So that's normally what happens in a normal cycle. Now, stagflation is where you have inflation moving up, but you have a contracting economy, which is very problematic for interest rates and the central bank, because when you have inflation that's rising, you normally should hike rates. But if you hike rates as inflation is rising, but GDP is contracting, rising interest rates will end up compounding the contraction of GDP. The reason why is because you're raising interest rates, borrowing costs, lending costs for businesses. You're raising interest rates on mortgages and homeowners who have got mortgages. So if that is the case, then they're going to have less spending. They're going to be spending more on their mortgages and less in on the high street and retail, and less for goods and services, right? So it contracts the economy. If you hike interest rates, it's problematic for the consumer, it's problematic for businesses. But if you cut interest rates to help the economy, to help businesses, to help the consumer, to lower mortgage costs, to lower borrowing and lending, then in fact you contribute to rising inflation, because inflation is weakening of a currency, is the devaluation of a currency, and cuts are designed to devalue the currency. So you can see the catch 22 that the Bank of England is in at the moment, and what stagflation, the problem of stagflation. You're kind of damned if you do and you're damned if you don't. So overall, that should actually be bearish for a currency. Stagflation is not bullish for a currency, it's bearish. So even if a central bank hikes rates or decides to hike rates, yeah, to combat rising inflation, of course they're going to be hurting the economy. And so, the investors are not going to like that either way. And again, investors are not going to like if um, the Bank of England help GDP by cutting rates, because at the moment you're seeing the UK economy flatline. The government's um, policies, Labour government's policies, are not really seen as growing the economy and actually hindering the economy. So if the central bank look to cut rates to help GDP grow, then they're gonna help with rising inflation, and inflation may rise a bit more, right? So, which is again detrimental to really the currency and the central bank, and the central bank's mandate. Actually, they're mandated to get inflation down to 2%. So it's a very, very, very tricky situation that the currency is in. But overall, what does that mean for the currency? And for me, it means more downside, right? Which is the reason why I ended up getting involved in a short trades here, which was a little bit profitable, but then this trade now is now still profitable. But again, I'll go over that a bit later on. If you are looking at going short on this pair, then you're really looking for, I guess, maybe a bit more of a pullback before going short, if it can do that. Or if prices make lower lows, then you're waiting for a pullback into a level of supply before going short. And so, yeah, the UK at the moment, I'll just read this out. It says investors are positioning for more weakness in the pound after the Bank of England's latest policy decision cemented their concerns about sputtering UK growth. Pictet Asset Management Limited has slashed its pound wagers since the start of the year. Hartford Funds and Russell Investments have also cut back, while RBC Blue Bay Assets management sees room to add to its already underweight stance as the market prices more interest rate cuts from the Bank of England this year. So pretty much you've got some asset managers who are quite bearish on the pound. And it says here, longer term, it's harder to see demand for the pound under the current UK fiscal and growth picture, says Shanil Ramji, portfolio manager at Pictet, who has cut his pound exposure since the start of the year to the minimum required for his portfolios. We still see risks to the economy and the need for more BOE cutting. And if they're correct, of course, more BOE cutting will mean, a depreciated pound. So, yeah, part of these resistance for me should still be to the downside. Pound yen, that's also been reflected in the pound yen. Of course, the yen and the Bank of Japan, they are hiking rates, and then you have the Bank of England who are looking to cut rates. So then you start to see the moves to the downside, which again should be the path of least resistance. So if you are looking at trading this pair, really you're gonna have to wait for maybe a bit more of a pullback, or if prices make lower highs, lower lows, you have to trade at that lower high. So I do think the path of these resistance is still to the downside. Um, so that's where, my direction is kind of focused on this pair. Looking at the euro equally weighted index, so this is just again like the dollar index. This is overall euro appreciation or devaluation against all of the other currencies, like the pound, sorry, the dollar, the pound, the yen, the CAD, the Australian dollar, the Swiss franc, and the New Zealand dollar. So overall, we're looking at a weaker euro, and yeah, I think this should probably continue to the downside. Fundamentally, we have Europe should continue with gradual monetary easing. And it says here from ING, the ECB cut rates again by 25 basis points in January, bringing the deposit rate down to 2.75%, while inflation has still or was still above target. The ECB justified this by stating that monetary policy is still restrictive. However, the closer it comes to the mythical neutral rate deemed to be around 2%, the more cautious the ECB is likely to become in the wake of weak growth. We do not exclude the possibility of the ECB adopting a slightly expansionary monetary policy, but this will be at the end stage of a very gradual process. Therefore, we expect a 25 basis point rate cut at every policy meeting to reach 1.75 by summer. Barring a major crisis, the ECB is unlikely to cut any further than this. So in comparison to, for example, the dollar and the Federal Reserve, who are looking to hold rates, whereas the ECB are looking to cut rates, when you look at the euro dollar, this is just basically a pullback, right? A lot of traders who are hyper focused on lower time frames, would have seen, this as being some sort of, what's happening with the dollar? Why is the dollar weakening? Why is the euro strengthening? But when you look at what's been happening, and you're not necessarily just looking at price, right? But if you are a trend trader, you're looking at the trend hasn't ended. But if you're a fundamental trader like myself, you're definitely not thinking that it's ended, because ultimately, if you understand that one central bank is looking to cut rates a lot more than another, then any pullbacks should be looked at as just selling opportunities. Are you going to always pick? Am I always going to pick the turn? No, because it depends on where the market thinks the dollar is a bargain and the euro thinks it's expensive, right? So we manage our risk. I ended up entering into a trade here, which ended up being a losing trade, but ultimately the direction was correct, right? I didn't manage to get involved in this because I didn't want to necessarily get into too many dollar positions, but ultimately, I did get into a dollar position, which other dollar positions which have sold off, and then you'll see in this start to happen. So I was right in the direction, and that's really what fundamentals are about. Is about picking the overall, the higher time frame directions. Lower time frames are more driven by liquidity, more driven by the market making side of things. But when you're looking at the higher time frames, this is where institutions are buying and selling, right? I mean, how much money do you think it takes for an institution to to move the market, that distance, right? That amount of pips. Same thing here. That the institutions definitely thought that this was a bargain for the dollar and expensive for the euro, right? It's just, it's not rocket science kind of thing. So those are the areas that you really want to look to trade around, in my opinion, right? Not, of course, everyone's got different opinions, but ultimately, the clues are in the moves, meaning that if you're seeing major moves from one area to another on a higher time frame, that big money were there, right? And will they be there again, right? So that was the start of that lower high, lower low movement. And so when you look across, and there we are, there was one there. That one just didn't happen to work out, right? But this one did. And then you just make back the money on your risk reward trades. So euro dollar, again, for me, still continue to be to move to the downside, in my opinion. Even if it moves up in the short term, I do believe that the overall direction should be to the downside, as long as the data supports it. That is the key. distinction between just blindly going short. You have to have the evidence, and the data has to support your fundamental bias. And so, as long as the data does support the fundamental bias, then of course you're just looking for, if price does something different, then just look at that as an opportunity to get short for and buy dollars for a cheaper price. Euro, yen. So again, the yen hiking rates, the euro looking to be quite dovish in the ECB. It's no wonder that these demand zones didn't work. So because really there's no value there. There's no one buying the euro, or not enough traders buying the euro uh, significantly enough to push it higher. So ultimately, if you are looking for a trade, again, path of these resistance is to the downside. I've been saying that really from around these areas, what should be happening, and eventually it obviously has happened. Now just looking for pullbacks if you want to look for a sell trade. Pound, euro pound. I think the euro pound I was kind of interested in this at one point, or semi interested, but now I'm not really interested in this pair. I think both currencies are on the weak side. The pound may have a little bit of an edge, but it's not enough for me to look to trade this. But if you are looking to buy the euro against the pound, then a pullback into that demand zone is actually quite nice. If you're looking for a short trade, then you'd have to wait for really prices to move to the upside before looking at going short. But not a pair I'm really interested in. Aussie dollar, US dollar. So again, we've pulled back up into this supply zone. I think the Australian dollar does look like a little bit of a buy, but fundamentally, but from a risk sentiment perspective, with tariffs against the dollar anyway, against the US dollar, it's more likely a sell. So commodity currencies are going to be hit with the tariffs, but in terms of overall which commodity currency is the strongest at the moment, or what I think is the strongest at the moment, I think it's the Australian dollar. But I still think the path of these resistance should still be to the downside on this pair. So if you are looking at getting short, then you should be looking at shorts now, or maybe a little bit more of a pullback before looking at going short on this pair. Gold. So gold, looking for a pullback to go long, was really the direction of travel, but that hasn't happened. It's broken to all new highs, and so again, all we have to do is kind of look for pullbacks right now with gold. Gold has obviously reacted to Trump's tariffs, and it says here Trump spurs haven demand. It is only February, and gold has already hit a series of fresh record highs this year. Tariff concerns that risk higher inflation and slower economic growth are spurring demand for safe haven assets like gold. With Trump back in the White House, uncertainty and unpredictability are running high, and gold will continue to benefit from this environment. And looking at a few charts, a few graphs, it says here lower borrowing costs are positive for gold. Central banks' appetite for gold likely to continue in 2025. Central banks' demand tops 100 tons for the third year in a row, 2022, 2023, 2024. So central banks buying lots of gold, and more ETF flows would give gold prices further boost, right? So we're seeing ETF holdings continue to kind of trend to the upside. So, looking at the fundamentals behind gold and the risk sentiment, then really, the path of these resistance should be really to the downside, trying to short at a level where where you're at all-time highs. You've got nothing to reference against. Where it may reverse, for me, is not the smartest move. Path of these resistance is still to the upside, so continue really on just buying on pullbacks. And the S&P, I think is likely to continue to enter into this auction, or this range, as it's commonly known, where you have prices moving sideways, right? Sideways, so it's going from here to here to here to here, and probably maybe move to the downside. Now, typically, stock markets will move higher based on a number of factors, but from a monetary policy perspective, whenever there are rate cuts coming, that means cheaper borrowing for investors to then put their money into a higher yielding asset. So with the Fed holding rates for now, maybe that the market is probably looking to take profits and look to reload on buying the stock market, the S&P, on the lower side. So my direction would be to look for still long trades. Of course, you could look for short trades if you want to, but ultimately I'd be looking for long trades at levels of demand. This level's been touched once, twice already, so ultimately I don't necessarily look for it to hold, although there is the possibility of a stop hunt probably at that level there. But ultimately I do think any pullbacks deeper into the lower side of this range, this auction, should be looked at as a nice buying opportunity. And so that brings us really to the end of the week's fundamentals, and getting into some new trades that I got into, as well as some trade updates on previous week's trades. So looking at the New Zealand dollar, and the New Zealand dollar, US dollar, again, fundamentally, it made sense to get involved short. This was a daily supply zone. So if you're looking at the daily right here, right, daily supply zone, and my entry was here at 8 o'clock UK time. Stop loss was up at, I can't really see that at the moment, but it was right there, as we've got this in the way. And yeah, so I ended up getting involved in two trades. So the I had three pending orders, sell pending orders, one there, and one there, and just looking for, when prices pull back and they trigger, then I'm looking to get in at a cheaper price, which it did, right? So on non-farm payrolls day, prices ended up coming back and triggering me into that position there. So this position ended up hitting a 1-to-1. 1 second, sorry, 1 second. Let me just move that, move this. So that ended up hitting a 1-to-1, right there. And then as prices dropped on the day, nice. So then that left me now. So that hit there and then dropped to a 1-to-1. And the reason why I go for a 1-to-1 on positions, especially if I'm in multiple positions, is to really just try to get myself to a break-even perspective. So if this position is, each position represents, let's say for example, 1%, just for math's sake, 1%, and this is all 4%. I would never risk 4% on any trade, but just for maths. Then if I get triggered into two positions, I get a 1-to-1 on this one. And what I'm doing is, if I get a 1-to-1 on that one, then I'm canceling these positions, right? These pending orders, right? Taking my risk out of the market once I hit profit target on any one of these. And then once I've banked that, then I'm only open on one position at 1%. And then if I lose that position, I'm at break even, right? I can keep my stop where it is. It makes managing the trade and holding the trade a lot easier psychologically if you know that you can't lose on a trade. Plus as well, my stop loss is in a safe place, right? And so ultimately, banking profits on this and then swing trading this makes holding trades a lot easier psychologically, right? Knowing that I can't lose. And then obviously I'm just looking to trail my stop down, right? So as this starts to make lower highs and lower lows, then I'll just trail my stop down behind swings and lock in some profits. And as I trail my stop down, locking in profits, and then I have an overall target really of, I think, somewhere down at the 0.55 level area here. That's where I'm ultimately aiming for somewhere around there. And let's see what happens, right? So this at the moment is a profitable trade. The worst case scenario, it'll be a break-even trade. But as Monday starts to open, Sunday night, Monday, I'll start to trail my stop down behind some of these swings. So New Zealand dollar at the moment, hopefully continues to be a profitable trade. Pound dollar. So last week, from a trade update perspective, I did get involved in this again. When prices pulled back, I got into two positions. One trade was a 1-to-1, right there. When it hit a 1-to-1, Oh, actually, it hit it there, hit it a lot earlier, right? When prices came back. And then I was only really in on this trade here, which when the market opened on Monday, I was thinking, yeah, brilliant, because my overall target was somewhere around these 1218, 121, yeah, about 1218 price level, but it didn't quite reach there. Of course, Donald Trump came out and gave the extension, so then prices moved to the upside. I trailed my stop down actually below this swing, so I ended up with a small loss on the second position, a full win on the first position. So that ended up overall being a small win on that trade. Not the greatest, but every win and every penny counts, right? So then the second position, or the second time I entered this trade, was around here, and so I only managed to get in on one position, though, unfortunately, as prices didn't pull back. So that was the high there. That was the entry right here, right there. Stop loss right there. And I hit a 1-to-1 right on the Bank of England there. But what I didn't do is I didn't take full profits. What I did is I took 50% off of this position. So again, just for math's sake, let's say for example that's one position, right? And I didn't get triggered in because price didn't pull back, so I'm only in one position. Once I hit a 1-to-1, remember my goal is to get to a break-even position. So what I did was I took 50% off, which means if this is like, for example, I don't know, £1, right? English money, then or 1%, I should really say. Let's say, for example, this is 1%, then I'm taking off 0.5% as I hit a 1-to-1, which again leaves me with only 0.5% in the market. I've banked 0.5%. So if prices do pull back and stop me out right at this highs again, this is a break even trade because I've banked half and lost half. So let's see. But now again with this trade, I'm trading my stop down, hiding behind swings. So I'm locking in some profits as prices move to the downside. And if I'm right about this trade, we should. I'm hoping that we should maybe move beyond that and maybe down to these 122 levels. As well, there's some forecasts that actually it could move down to the 119s. So I'll look to again hold this trade and swing trade this. Maybe add into trades if the opportunity presents itself as well. So that's the update on the pound dollar. Brent. So update on Brent. So last week managed to get triggered into 3 positions. One position was a winner, and then I ended up having 2 losers. So really small loss on that one. And then this position, we've got this one here. I managed to enter on that candlestick around there, and again enter into 4 positions, 1, 2, 3, and as prices pull back, that position there, that position ended up being actually a winner, hitting a 1-to-1 as it pulled back to right there. That ended up being a nice 1-to-1. Let me show you 1 second. Don't know why it's all the way up there. Right, so let me show you. So as prices dip down, yeah, right, dip down into that position, that lower position, and triggered me in. Then it hit profits right there. Nice 1-to-1 trade. So now I'm in 3 positions still with my stop loss at the same place. I've got a buy position here, buy position there, buy position there, and hopefully, if the sanctions that Donald Trump is putting on Iran does kind of spook the market, then we should see a bit more upside in in oil. That's what I'm hoping anyway. So let's see what happens with this Brent trade this week. And then the final trade update was the Swiss yen. So I know many of you may have been in this trade. I know a few of the guys in the private members group were got in on this trade as well. Managed to take profit on this. This actually was a really nice a 5.5 to 1 trade. So if and also as well, I did hit a 1 to 1 on one of the other positions as well when it pulled back. So that was nice. So one position was a 1 to 1, and then the final position was actually a basically a 5.5 to 1. So that was a really nice trade. And again, yes, prices continued moving to the downside, but I thought that taking profit is the right thing to do. I could have trailed my stop down, of course, but ultimately I had a kind of price target that I thought prices may get to, and so it did. And so I'm happy taking profits there. If I had held on, of course, right now it'd be at maybe about a 7 to 1, but 5.5 to 1 is okay. I'll just wait for a pullback on the higher time frame. Prices always pull back to some degree. Not saying that it's going to be anytime soon, but if it does pull back, then brilliant. Yeah, I'll just look for short trades there. Or if prices continue making lower highs, lower lows, let's say, right, something like that, then I'll just wait for prices to pull back up into that lower high before, getting another trade uh, right there. So I'm fully out of this trade now. And that is the trade update on the Swiss yen. So again, buying the Bank of Japan hawkishness and selling the Swiss franc dovishness. So that's it for this week. I hope you enjoyed the analysis. Don't forget to like, subscribe, and share it with your fellow trading colleagues and across your social media platforms if you find the information I provide useful. And so take care, have a great trading week, and all the best.